A 15-year mortgage can make you feel like you are winning. You pay the house off faster. You save a large amount of interest. You watch the loan balance fall every month. And somewhere in your mind, it feels like the responsible choice. But here is the part most people never calculate. The money you use to pay off the house faster does not disappear. It goes somewhere. And where it goes may change your entire financial future. Because a 15-year mortgage is not just a mortgage decision. It is a cash flow decision. It decides how much money stays available in your life, how much money gets locked inside your home, and how much time your money has to compound somewhere else. And that is where the real math begins. Not with the interest you saved, but with the wealth you may never build. That is exactly what happened to Jake. Jake was 34 when he bought his first real home. It was not a mansion. It was not some luxury property. It was a normal house in a normal neighborhood. The kind of house a disciplined person buys when they are trying to build a stable life. The home cost $400,000. Jake put $80,000 down. That left him with a $320,000 mortgage. When the lender showed him the options, the 15-year mortgage looked like the obvious smart choice. The interest rate was 6%. The monthly payment was about $2,700 for principal and interest. It was a big payment, not impossible, but heavy. Still, Jake liked what it represented. Discipline, control, a paid-off house before age 50. And to him, the 30-year mortgage looked weaker. The payment was lower, but the loan lasted twice as long. The total interest was much higher. And Jake had heard the same advice for years. If you can afford the 15-year mortgage, take it. So he did. And for a long time, Jake looked like the person who made the smart decision. Every month, more of his payment went toward principal. Every year, the balance dropped faster. His equity grew. His debt shrank. He could see progress. That is what makes the 15-year mortgage so emotionally powerful. It gives you visible proof that you are doing something right. You can open your mortgage statement and see the balance falling. You can imagine the day when the payment disappears. You can picture yourself owning the house free and clear while other people are still sending money to the bank. That feeling is real, and it matters. But feelings are not the whole calculation. Because on the same street, at the same time, Marcus made a different choice. Marcus bought the same $400,000 house. He also put $80,000 down. He also borrowed $320,000. But Marcus chose the 30-year mortgage. His interest rate was 6.5%. His monthly payment was about $2,022. That meant Marcus had about $678 more cash flow every month compared to Jake. And Marcus had a plan. He was not going to waste the difference. He was not going to let the lower payment turn into a bigger lifestyle. He was going to invest it. At least, that is what he told himself. And this is where many financial plans sound smart in theory, but die quietly in real life. At first, Marcus did invest some of the difference. A few $100s here, a transfer there. Some months, he really did follow the plan. But then, life started doing what life always does. A car repair came up. A family trip felt worth it. The house needed maintenance. Groceries got more expensive. A child needed something. A few dinners out did not feel like a big deal. And the extra cash flow slowly disappeared. Not in one dramatic mistake, not in one reckless purchase, just through normal life. That is why Marcus is important. Marcus did not fail because he was stupid. He failed because unassigned money rarely stays unassigned. If money does not have a job, life will give it one. And after 15 years, the difference was brutal. Jake's mortgage was completely paid off. Assuming the house appreciated at about 3% per year, his home was worth around $646,000. He had no mortgage balance, no lender attached to the house, no principal and interest payment left. On paper, Jake had about $646,000 in home equity. Marcus also owned a house worth about $646,000. But he still owed around $235,000 on the mortgage. That gave him about $411,000 in home equity. And the investment account he promised to build? It had only grown to about $30,000. So Marcus's total position was roughly $441,000. Jake was ahead by more than $200,000. If the story ends here, the lesson looks obvious. Take the 15-year mortgage, force the discipline, pay off the house. Avoid becoming Marcus. And honestly, for many people, that lesson is not wrong. Because if you choose the 30-year mortgage but never invest the difference, you probably do lose. You keep the debt longer. You pay more interest. You carry the mortgage deeper into life. And the extra cash flow gets absorbed into your lifestyle. That is why the 15-year mortgage is so easy to defend. It protects people from themselves. But Marcus was not the strongest version of the 30-year mortgage strategy. Marcus was the warning. The real test was Mia. Mia bought the same house, same $400,000 price, same $80,000 down payment, same $320,000 mortgage. Like Marcus, she chose the 30-year mortgage at 6.5%. Her monthly payment was also about $2,022. But Mia did one thing Marcus did not do. She removed the decision from her life. She calculated the difference between the 15-year payment and the 30-year payment. That number was $678. Then she automated it. Every month, right after the mortgage payment cleared, $678 moved into a broad market index fund. She did not wait to see how she felt. She did not wait until the end of the month. She did not depend on discipline after bills, stress, groceries, and life had already taken their share. The money moved before her lifestyle could touch it. That single difference changed the entire story. For the first few years, Jake still looked better. His mortgage balance was falling fast. Mia's balance was falling slowly. Jake had more home equity. Mia had an investment account, but it did not look impressive yet. And this is why compounding is so easy to underestimate. In the beginning, compounding looks weak. It looks boring. It looks like nothing is happening. But the quiet years are where the future gap is created. After 15 years, Mia had invested $678 every month. Assuming a 7% real return for illustration, her investment account was worth about $215,000. Her house was worth the same $646,000 as Jake's, but she still owed about $235,000 on the mortgage. That gave her around $411,000 in home equity. Add the $215,000 investment account, and Mia's total position was about $626,000. Jake was at about $646,000. So at year 15, Jake was still slightly ahead. And that matters, because the 15-year mortgage really does create a strong early result. It is not fake discipline. It is not a bad financial move. It builds equity fast. It reduces debt fast. It creates a paid-off house faster. But year 15 is not the finish line. That is where the real math begins to turn. From year 15 to year 30, Jake no longer has a mortgage payment. So now, Jake can invest the full $2,700 per month that used to go to the lender. That sounds powerful, and it is. If Jake invests $2,700 per month for the next 15 years, assuming the same 7% real return for illustration, he ends with around $680,000 in investments. His house also keeps appreciating. By year 30, the house is worth about $1,005,000. So Jake's total position is roughly $1,685,000. That is a strong outcome. A paid-off house, a large investment account, a high net worth. Nobody should pretend Jake failed. But now look at Mia. Mia continues paying her 30-year mortgage. She continues investing the $678 difference. And by year 30, her mortgage is also paid off. Her house is worth the same $1,005,000. But her investment account is where the story changes. The money Mia invested during the first 15 years did not stop working. It kept compounding. Those early dollars had time. And in money decisions, time is not a small detail. Time is the engine. By year 30, Mia's investment account grows to about $1,290,000. Add the same $1,005,000 house, and Mia's total position is about $2,295,000. Jake ended with about $1,685,000. Mia ended with about $2,295,000. That is a gap of roughly $610,000. Same house, same down payment, same starting point, same monthly comparison. The difference was not the property. The difference was what happened to the cash flow. And this is the part most people miss. A 15-year mortgage is often described as saving interest, but it is also a forced investment into home equity. Every extra dollar Jake paid toward the mortgage gave him a return close to his mortgage rate. In this case, about 6%. That is not bad, but it was not liquid. It was locked inside the house. If Jake needed that money, he could not simply click a button and withdraw it. He might have to sell the home, apply for a home equity line of credit, refinance, or borrow against the property. And those options are not always easy when life is already stressful. Home equity feels safe, but it does not always behave like cash. Mia's investment account was different. It moved up and down with the market. It carried risk. It was not guaranteed. But it also created liquidity, flexibility, and compounding outside the house. That matters because the real question is not only, how fast can I pay off this mortgage? The better question is, what does this decision do to my options? A 15-year mortgage gives you a faster payoff, but it also gives you a higher required payment. And that word matters. Required. If life changes, the lender does not care that you chose discipline. If you lose your job, the payment is still due. If medical bills show up, the payment is still due. If your income drops, the payment does not automatically shrink. A 30-year mortgage gives you a lower required payment. You can still pay extra. You can still invest. You can still build wealth aggressively. But you are not forced into the higher payment every month. That flexibility has value, but only if you use it correctly. If the lower payment becomes lifestyle spending, you become Marcus. If the lower payment becomes automated investing, you become Mia. That is why the answer is not as simple as saying 15-year good, 30-year bad. The 15-year mortgage may be better for someone who hates debt, values emotional peace, has stable income, and knows they will not invest the difference. For that person, forced discipline may be useful. The 30-year mortgage may be better for someone who can automate investing, tolerate market volatility, keep a long-term mindset, and leave the money alone for decades. For that person, flexibility can become a wealth-building machine. But there is one uncomfortable truth here. Most people think they are Mia. Many people become Marcus. They choose the lower payment. They promise to invest the difference. Then ordinary life quietly claims the money. Not because they are bad with money, because life is very good at spending money that has no assignment. That is why automation matters. The strategy only works when the investment happens before the spending decision, not after. Not when you feel motivated. Not if there is anything left over. Before. The difference must be calculated. The transfer must be automatic. The investment must happen consistently. And the account must be left alone long enough for compounding to matter. Without that system, the 30-year mortgage is just a lower payment and a longer loan. With that system, it becomes something very different. It becomes a way to own the same house while building a second engine of wealth outside the house. And that is the real math. The 15-year mortgage buys certainty. The 30-year mortgage buys optionality. But optionality only creates wealth when your behavior does not destroy it. Jake's money built equity faster. Mia's money built equity and investments at the same time. Jake won early. Mia won later. Marcus showed what happens when a smart plan never becomes a system. So before you assume the 15-year mortgage is automatically the responsible choice, ask a harder question. Are you choosing it because it is truly the best use of your money? Or are you choosing it because you do not trust yourself to invest the difference? That is not an insult. That may be the honest answer. And sometimes the honest answer matters more than the spreadsheet. Because a perfect strategy you will not follow is worse than an imperfect strategy you can actually execute. If you know the extra money would disappear, the 15-year mortgage may protect you from yourself. It may turn discipline into a monthly requirement. It may give you peace. It may help you sleep. And that has real value. But if you can automate the difference and stay consistent, the 30-year mortgage may give you something the 15-year mortgage cannot. More liquidity, more flexibility, more compounding time, more options. And over 30 years, those options can become much larger than the interest you saved. So the real winner is not automatically the person who pays off the house first. The real winner is the person who understands what every dollar is doing. Jake won the visible game. He paid off the house. He killed the mortgage. He felt the peace of being debt-free. Marcus had the right idea, but no system. He kept the cash flow, but failed to turn it into wealth. Mia did the thing most people only say they will do. She invested the difference. Early, automatically, consistently. And because she did it before life could touch the money, the gap grew quietly for decades. That is the lesson. A mortgage is not just a loan. It is a cash flow machine. It affects your liquidity, your risk, your investment timeline, your emotional comfort, your future options, and your ability to build wealth outside your home. So do not get a 15-year mortgage just because it sounds more responsible. And do not get a 30-year mortgage just because the payment feels easier. Look at the whole system. Look at the payment. Look at the interest. Look at the opportunity cost. Look at your behavior. Look at your discipline. Look at what happens over 30 years, not just 15. Because the real math is not only what you save, it is what you build. And sometimes, the most expensive financial decision is not the one with the highest interest. It is the one that gives you peace today, while quietly taking away options tomorrow. So now the real question is this. If you were buying a home today, would you choose the 15-year mortgage for certainty or the 30-year mortgage and invest the difference? Comment below, because this question usually reveals how people really think about money. And if this breakdown helped you see the mortgage decision differently, like the video and subscribe to Money Logic for more real-world financial breakdowns. This video is for educational and entertainment purposes only. It reflects general financial ideas and personal perspective, not personal financial advice. Investment returns are not guaranteed, mortgage terms vary, and every financial situation is different. Always do your own research and consider speaking with a qualified financial professional before making major financial decisions.